Good evening, everyone, and welcome to tonight's live stream. Hope you're all doing well and you're enjoying your evening. It is December the 1st. It's already December, a few more days left in the year, and we'll be moving into 2022. I'm going to do live streams right up until about the middle of the year and then probably take a break for the holiday. Please let me know if you can hear me okay in the live stream. You can put your comments in the field so that I can know that you can hear me all right. So if someone can give me a thumbs up, that would be awesome. And that way I know you can hear me just fine, and I'll begin this session. So I'm just going to wait for everybody to join the session, and we will be right back in a minute. Aren't we there already? Susan, do you mean aren't we there already in terms of the new year starting? I'm not sure. But I hope we get there soon, because I want to get out of 2021. Although it was a great year in terms of the markets, everybody was making money, which is good news. We just went through a lot, right? It was really difficult to always be changing our schedule around in terms of the restrictions, what we could do, getting the shots, getting the first, getting the second. It was really, really difficult. But we are, yeah, Susan, we're going to talk about recession right now, and I'm going to jump into it. So it looks like you can hear me okay. So I'm going to jump right into this right away and talk today about something that I think is really important for you to know about. Today, we're going to be talking about Omicron a little bit, more about the effects of what's been happening with the coronavirus and restrictions and so on, and how that's affecting the economy, how it's affecting the way that we work and live. This isn't me going to be on a soapbox complaining or anything. It's just really about how it's affecting us in terms of what to expect in terms of our economy, employment, being able to move around, and obviously your money, your investments. And I'm going to share with you some insights to explain how do we get a sense of pending or looming recessions. And I'm going to jump right into that. So again, I thank you so much for joining us today. My name is David Aaron. I am an advisor, Aaron Wealth Management. I provide all kinds of insights and videos on all things financial investing, retirement, life insurance, for business owners, individuals. I'm an investment advisor, insurance professional, so I actually help clients through all of those issues. So if you're in need of any help with financial planning, that's typically what I do. So why don't we just jump right into this? If you're new to my channel, you might be streaming across. I see Susan is watching this on LinkedIn. Well done. Thanks for tuning in there, Susan. It's also streaming across Facebook and YouTube simultaneously. So if you are new to this channel, please hit the follow or subscribe button and put your comments and share and like this with everybody that you think needs to see this. So let's move on to the first graphic. I've got a number of things I'm going to share with you, and I'm really looking forward to your questions. Okay, so the first one is just to make some general remarks. Unsustainable boom is associated with easy money and artificially low interest rates. That has to do with the amount of money that governments all over the world have been pumping into the economy, trying to make sure that the economy has enough capital. In fact, a lot of capital. Our own Prime Minister of Canada is saying he's not really concerned about inflation, or the economy is really more interested in pushing as much money towards people so that they can pay their bills. Now, the amount of money that we've been given to help you through month by month as you're not working is not paying the bills. It's actually making things very difficult for people. The next thing is when banks change course and tighten, interest rates rise and trigger the inevitable bust. That is what we're really going to focus on now, because the US government, Canadian government have both signaled that they're about to change course on how much money they're going to be pumping into the markets, and talking about inflation. So there's been a change. For a while now, they were denying inflation, that it wasn't an issue. For a while, they were saying, hey, we're not worried about inflation rising. We're not worried about this at all. Now they're talking about some things I don't want to tip my hand, but they're going to be talking about how they're going to be changing their position on how they're going to be managing our economy, managing the money flow. And this is really important for you to know. So I'm going to talk a little bit about yield curve. Now, everybody's about to dump out of here and go, I don't want to talk about graphs and charts and yield curve. This is just way too much information. But I'm going to just make this really simple and straightforward so that you can understand what this means, okay? Because these are leading indicators as to what happens in the market. Okay. Yield curve. It's a graph that represents the relationship between short-term and long-term interest rates of U.S. Treasury notes. And so what I'm going to share with you is here's a few illustrations going forward, and I'll explain it all. So the first illustration here is the U.S. Treasury bond interest rate. You see here, short-term, 1%. Don't worry about the actual percent, okay? But this is just the relationship between the short term and the longer term. There's a 30-year. So it's not necessarily 1 and 3%. I just want you to understand that there is a short term and a long-term relationship. Sometimes this chart, the graph, sometimes it begins to flatten out. And that's called the flattening yield curve. This is where the short term and the long-term rates start to get even. And then sometimes, on a rare occasion, this happens when short-term rates are higher than long-term rates. That's called an inverted yield curve. And, I'll just give you a quick definition. An inverted yield curve represents a situation in which long-term debt instruments have lower yields than short-term debt instruments. And why is this important to you? Well, because yield curve is incredibly accurate in predicting recessions. You're not going to believe this. When I share this chart with you, you are not going to believe. You may have not known this. The average person, average investor doesn't really pay attention to this, but it's remarkably accurate what the yield curve does. Periodic short duration yield curve inversions. So going back to this here, this is an inversion, right? Periodic short-term duration inversions are like having back pain. Now, I equate this to back pain because I want to relate it to just regular people, okay? When you have back pain, it's really a leading indicator that something bad is going to happen, right? Your back is going to go out on you. And you have to do something about it. You have to figure out different exercises, start stretching more, but essentially you feel that back pain and you go, man, I've got to do something, and you change. And that's exactly what the government is doing. They are changing their position right now as to what they've been doing all along. So let's have a look at a couple of things. If you're into this and you understand it so far, let me know. Give me a thumbs up. Give me a yeah, whatever you want to say in the comments. But if I'm going too fast, let me know. But this is what we're going to be talking about. The relationship. Remember I said before that it's a relationship between long-term and short-term yields. And so this has a remarkable ability to predict recessions. In each of the years in which short-term, that's that 3-month Treasury note, went below zero, you see here the relationship in this, you had a recession. It's not how do I say this? It's not a fluke. Look at here again. Every time it went below zero, a recession happened in the US. Every single time over the past 50 years. And that's the relationship between the short-term and the long-term Treasury note. So why is this important? Because recently we had an inversion. And it's not like inversion happens and bang, we hit a recession. Usually what happens, the inversion, go to this chart here. An inversion happens. So if you look at 2009, for instance, okay, 2009, see how it went and dipped below 0%. So it dipped below, and then it actually began to rise, and then the recession hit. So when an inversion happens, we can expect to see a recession occur a year to a year and a half from that point. And we just recently had an inversion. Now we can have periodic short-term inversions, but what that's really saying is it's like this. It's having these periodic back pain, and it's letting us know, pay attention, because this is not stable right now. So why I'm sharing this with you right now is because I want you to be prepared for a few things. Now, if you were to just isolate this instance and not include what I'm about to say, then you could say, well, maybe if they just changed a little bit, the government changed a little bit with their monetary decisions, that they can avert a recession. But let's add a few more pieces to the puzzle, okay? So this inversion is really the beginning of a recession warning. Causes big daily swings in the market. So this is the Toronto market. This is a 5-day, I think, here, a 5-day. And you can see the incredible volatility. This is just the last 5 days. You can see the incredible volatility. And what happens that a lot of investors don't know about is that the way trading is done is it's not just simply, you and I clicking a button. A lot of this is done automated. And so whenever, in terms of that automation, triggers go off and selling and buying occurs automatically. And so in the case of when you see this kind of thing happening, those triggers go off and it sends, that's the chart I want you to see. And it sends the market into absolute chaos. And you see these huge swings. So it's not you and I, the little investor, buying and selling. This is like millions of trades that are happening, and it's causing the market to swing rapidly. And that's the problem right now. When there is an inversion, it's causing those triggers to go off, and it creates these huge daily swings. And then you add in the next few items, okay? So Canada inflation rate climbs. These are the recent headlines. Climbs to over 18-year high. Canada August inflation rate, highest since 2003. Now, you know this already because before I go into that, you know this already because you've noticed that you have less money in your pocket every month, right? When you go to the gas station, you'll notice the price of gas is way up. Food costs, go to the grocery store, start buying, meat, incredibly expensive, dairy expensive, produce expensive, and there's a limited variety of products. You're going to experience this when you do your Christmas shopping. You'll go in to buy something, let's say at a store or even online, and you'll order it, and it won't be in that size, and it might take a week or two for them to send you one. So it's not simply there on the shelf. So instead of having 20 varieties of something, there might be only 7. So it's something you're going to notice, and that's because of supply chain issues. Now, inflation. This is the most recent numbers on inflation, 4.7%. Look where we were a year ago in January 2021, 1%. And inside of 12 months, we're at 4.7%. And that is with COVID-1, COVID 2.0, and now we have Omicron. So I'm of the mind that when you start to take away problems, then things become better for you, right? Things become easier. So we have COVID-1, COVID-2, and now we have Omicron, and we're kind of being told that it's not going to be a problem. I'm of the belief that things are not going to go to normal anytime soon. Just check. I have, where does money go with this? Outflows from stocks. Okay. I'll get to that in a few minutes, Bob. Hold on a second. Where was I here? I showed you this chart, right? So that is the way the markets are going. Inflation, supply chain, and inflation. So cost of everything is going up. And now we're adding in a few things. So in this case, quantitative easing. The government is changing their policy along with the US about how they're going to be purchasing the government of Canada bonds. So you'll notice here that they're now going to a reinvestment phase where they're going to purchase government Canada bonds, which are maturing. This is a complete reversal of what has been going on. Now, the Omicron. Let's talk about the Omicron variant. Cases so far of Omicron seem to be less serious than the Delta so far, but that's what they're telling us so far because it's really new. And what I'm thinking is that people are going to be thinking this. If you're not thinking this, this is how I'm reacting to it as well. And that is, why are people reacting so strongly? This is this graph here, that downslide you see in the Toronto stock market is a result of feeling this. People are worried about going back to what happened in March last year, 2020, when the market dropped by 30 or 35% because of fear. All of a sudden, people telling us that we had to stay in our homes and buy toilet paper. I know it sounds a little sarcastic, but it really was very sarcastic because people were really worried about going to the bathroom than getting vitamin C and getting what they needed to do to be safe. But with Omicron coming in from Europe, people are thinking, are we going to go back to that? Do I have to worry about this happening to the market again? And that's why we saw such sudden, along with everything else, sudden ups and downs in the market. Now, despite Omicron having this here, a less serious than the Delta variant, Canada has decided to do restrictions again on travel. And this is just the beginning. The United States, all over Europe, they're all deciding to implement restrictions. So why am I telling you these things? Because it's important that you don't do a knee-jerk reaction and just simply think what happened this past week is going to be a revisiting of 2000 when the markets dropped and plummeted so rapidly. I don't see that happening. And the reason why I don't see that happening is, one, everyone, well, not everyone, but about 95% of the population is vaccinated. And so we've already have we're not starting from the beginning again. We already have an understanding of how to behave, how to keep ourselves safe. We understand social distancing. Even though it was a pain for us to go through that, we understand now that we have to, wear a mask and sanitize our hands everywhere, keep distance from one another. So I don't think we're going to be going back to the same massive restriction that we had. But what it's happening is it's creating this fear among everyone. And so what I want to share with you today is just a couple of things. And that is, if you are in this period of your life where, if you notice this chart, this is a retirement income timeline. If you're 5 years, let's say you retired at 65 and you're 60 today, you have to be aware that the market is going to be really volatile and that you cannot afford to be going through these ups and downs with your portfolios. You have to change the way your portfolio is invested. Now, I don't mean to say get out of the market, but you have to change the way you have weighted your asset allocation. So how much fixed income versus how much equity, what kind of equity? Is it in North America? Is it only in Canada? Is it in Europe, in Asia? You have to talk to your advisor about how to build a portfolio. If you are in this age group where you are 5 years from retirement, you have to build a portfolio that is more defensive and less offensive. Now, bear in mind, if you're 60 today, you have another 40, 45, well, not 45, but let's say 35 years of living, where you can expect men and women to live between 26 to 28 years in retirement. So you still have a long time to use your money. And whatever happens this year is really not going to impact your portfolio tremendously long-term, but you just don't want to have negative returns in this, like severe negative returns in this window of 5 years. So you want to make sure that your portfolio is structured in a way that is more defensive than offensive. If you're young, you can notice here, go back to this chart. If you're younger than 60 and you're in your 50s, you still have plenty of time. If you just feel more at ease and you want to sleep comfortably and you can't handle the ups and downs of the market. It's okay to get a little bit more defensive. Just understand that you want to talk to your advisor, not every day, but you want to talk to your advisor maybe every quarter and say, do you think it's time that we get a little bit more aggressive, or should we stay the same way? Having more frequent conversations with your advisor is really important during these times of real uncertainty of what's happening with the variant, the Omicron variant, what's happening with the economy. As they start to tighten the screws, you're going to see things are going to change. Really, you're going to feel it in your pocketbook. Interest rates are going to go up. Mortgage rates are going to go up. It's going to cause you a lot of hardship for companies that use money and borrow money. It's going to cost more money for those companies to borrow. They're going to translate that extra cost down to us, the consumer, and you're going to see the prices of things go up. And when you add into the fact that we still have supply chain problems, those costs are going to just continue to be high. So if you're thinking we're going to get a break on costs, it's not. We're going to be in this situation for a long time. Now, the other issue is about the about recession. You know, I like to think that having increased costs is like having a recession, isn't it? It's costing me a lot more money than I normally have to spend on things, and it results in me having less money every month. In my mind, that feels to me like a recession. It feels like a tax to me. And so what I want to prepare you for is not so much not spending money, but just being aware of that you want to have enough money in your account, let's say short-term savings in your account, to make sure you can weather 3 to 6 months of, you know, pretty expensive gas prices, food costs. I think you want to be in a position where you're healthy financially for the next 6 months. Make sure you're not going too wild with spending, because it is likely that we could go into recession a year and a half from now. So right now it's not a problem, and you're thinking, oh great, I'll look at it next year or a year and a half from now. But it's important for you to pay attention to what's happening right now in the economy as we move into the winter months. If there are more restrictions placed on us, you want to make sure you just have a little bit more savings in your portfolio. Now, the way that you do that is you get with a financial advisor. I put this screen on almost every presentation that I do when I talk about financial plan. It's seeing the outcome of your planning decisions before you commit to them. Such a powerful statement. It's important that you actually have a written financial plan that addresses not just the upside of, you know, a lot of advisors say, well, if you get 7, 8, 9%, whatever rate of return they're putting in on your financial plan, here's what it's going to look like. What you also want them to show you is what's the opposite effect of that. What happens if we go into recession and we have negative returns for the next 6 months, 8 months, and then we have maybe 4 or 5% a year after that? How does that affect my investment strategies? How does that affect my retirement, or how does that affect my short-term saving strategy? Those things are so important for you to pay attention to. So in closing, talk with your advisor more often. Make sure your portfolio is a slightly more defensive for the next 6 months. Don't pay attention to the noise too much, because if you watch the markets and, you know, the news wants to sell fear. That's how they get people to pay attention. So if you're just watching the news, you're going to see some really awful things. And one thing I'll throw in here in the end, and that is, it's going to get ugly too over the next year, because we'll start entering a US election cycle. And that's when the news is going to go up and down. They're going to want to sell news. People are going to be talking about what's wrong with the economy in Canada, what's wrong with the economy in the United States. And they're going to be saying a lot of things. And so I want you to just, you know, weather the storm. Don't get too excited. Don't get too nervous, but do talk to your advisor to make sure, are you in a good position moving forward, and can you be a little bit defensive and still get a decent rate of return for your portfolios. Again, I want to thank you for tuning in today. Today was a day where I just wanted to talk about what I think might be happening. I don't have a crystal ball on my desk, but I just wanted to share with you how we look at predictors of what might happen in the near term. And near term, we're talking about maybe a year from now. And right now, it's telling us that Maybe not 2022, but 2023 really looks like we could have a recession. And so I hope you enjoy that information. Food for thought, just to make sure you're looking after your money over the next year. If you have any questions, put them in the comments below. This video will be saved on YouTube and on Facebook. It gets removed after 2 weeks on LinkedIn. It's just the way they do that. But I reply to everybody's comments and questions. And so I'll be sure to get back to you with anything that you need from me. Again, thanks so much for tuning in. I'll be live with you again next Wednesday at 7 o'clock. Tune in tomorrow morning at 10 a.m. for I'm dropping another video at 10 a.m. Last question, Parissa, what do you think is happening for real estate? Wow. I'm not a real estate investor. If you talk to a real estate investor, they're all going to tell you the real estate is going to go up. What I can tell you about real estate, and it depends on where you are, but I can tell you this, I'm in Toronto. So from a GTA planning point of view, the GTA is very, very worried and concerned about their ability to keep up with demand for the growth, population demand in the GTA. They know that they're expecting to have, I don't have the numbers handy, but they know that infrastructure, so not just housing, but talking about like a transit system, roads, all these things are of great importance, and they're worried that they're not going to be able to keep up with the amount of population that's going to be pouring into the GTA. So I don't suspect that housing is going to experience a bubble burst, so to speak. I think they're going to keep on building homes. They're going to keep on building condos. That's not going to change. What will happen, and this is just economics, if they begin raising interest rates, and if we hit a recession in 2023, that's going to put a lot of pressure on people who have high ratio mortgages. And that's bad news, right? For people losing their homes and having to get out of homes earlier than they wanted to. And that might cause a temporary easement in terms of what housing prices might happen. There's an interesting, if anybody wants, I don't have it handy in front of me, but if anybody wants a website where you can track real estate right across Canada and housing prices and what's hot, what areas are hot, what have experienced the greatest advances in terms of price and what has gone down, please let me know. Just message me and I'll send you the link. It's awesome. I refer to it all the time because it's really interesting to know where homes are going up and where they're not. But great question, Parissa. Thanks very much for tuning in. I hope to see you again next Wednesday at 7 o'clock. If anybody wants to tune in live tomorrow, because it's a live, it's a premiere on YouTube. So go to my YouTube channel. It's premiering at 10 a.m. So I will actually be on live answering your questions at that time. Again, thanks so much for tuning in. And I look forward to seeing you next week and tomorrow morning at 10 o'clock on my YouTube channel. Thanks so much. Take care.